what I wanted to talk about today, at least start off with, is what I do professionally. I figured it would be most interesting to many of you to talk about venture capital and startups and innovation, and I'm going to go deeper here. So let me start with venture capital. What is the definition of venture capital? When you are investing your own money, that's being an angel investor. When you're investing primarily other people's money, that's what a venture capitalist. Um, and you're right, it is usually for equity, but not always. And it's usually in a startup, but not always either. Um, and let me expand on that. So I am a venture capitalist running my own fund, and I focus on seed stage. Seed stage is, roughly speaking, the first round that a startup is doing when they're raising money from outsiders. After seed, you have something called a Series A, Series B, Series C, and there's letters. What those letters means, we'll get into just a little bit. But I'm focused on investing in this stage. And when I'm investing, I'm about half of the time getting equity. I'm getting a percentage ownership in the company. But about the other half of the time, I'm getting actually debt. And I don't know if all of you here have heard the term convertible notes. Another way of making an investment in a company where I say, look, I don't know how much this company is worth, so I'm not going to try buying a part of the company. I'm going to loan you money. And when you are actually worth something, then my loan will convert into an ownership of the company. So then it becomes equity. It's basically debt that becomes equity. So I think, Anand, you are absolutely right. The goal here is to have equity, but it's not always right away that I get equity. And there's exceptions to this also. Like at some points, people may buy different kinds of things into a company, but usually you're buying equity. Equity is ownership, essentially. Let's say I have 10 apples and I give up one apple to somebody else because he's giving me water so that I can water the plant. I gave up 10% equity, right, in terms of apples. If now I have a company and I give up shares, shares is how a company is defined, right? Like a company may have 10 shares and I give up one share, then I've given up 10% of equity in my company to somebody else. So let me explain what debt is, because that might also be confusing. Let's say I had 10 apples or 10 shares, and I say, look, I'm not going to give you apples, but I need money. I need water, right? So why don't you loan me? And at some point, I will pay you back. So somebody says, okay, you know what? I'll give you a gallon of water so you can water your tree. But about a year from now, I don't want one apple. I want 2 apples. You have to give me 2 apples for this gallon of water. That is a loan. And about a year from now, I will give this person 2 apples. That loan that I have given gets converted into equity a year from now. The same thing happens in companies. I have shares. I can give away shares right away, or I can get a loan and give away those shares at a later date. Does a company need to succeed? They need to hire the right people. They need to figure out how to succeed against the competition. They need to figure out what the market is and launch the right set of products. They need to keep adapting. They need to spend money for marketing. They need to spend money for branding. They need to spend to create a business model where they get money. Then they need to figure out, what is the cost of acquiring a customer? How much will this customer pay? In the lifetime of this customer, how much is he or she worth to me, right? Like there's thousands and thousands of questions that a business has to answer. And a venture capitalist is presumably somebody who can help you with all those questions. A venture think of it as any kind of sport, right? Like in a sport, you have a bunch of athletes, they're playing the sport, whether it's football, whether it's soccer, whether it's hockey, right? But there's a coach, and the coach's job is to make all the athletes, all the players as successful as possible. A venture capitalist is like a coach that gives you money, that gives you advice, and that reprimands you when you do something wrong, and then encourages you when you do something right. And the players are the ones out there scoring the goals and the touchdowns and the 3-pointers and so on. So the relationship between an entrepreneur and a venture capitalist, it can be a fantastic relationship when they're both working well together. It can also be a terrible relationship if they end up fighting with each other. And a venture capitalist owns a part of your business. So they are far more than just a supplier or a client. They're actually a partner and an owner with you in the company.
What factors go into deciding which company to invest in?
I'll look into a lot of things. I'll look into, before even looking at measures of methods, I'll look into the team. Who are they? What their experience is this the best team for me to invest in? Can they work well with each other? Can they work well with me? These are a lot of qualitative questions. Then I'll look into technology. What are they building? How is it defensible? How is it different? What would it take for somebody else to build it? So on. And then I'll look into traction, meaning how many customers do they have? And now I'm getting into Stephanie's question. What is the cost of acquiring their customer? How much money do they pay? What is the lifetime value of this customer? What is the churn, meaning how many of these customers end up not staying with the product? And there's a whole set of metrics. One of them is also ARR, annual recurring revenue. So how much money is being paid to this company on a recurring basis? And the metrics, how much weight I give to these metrics will change based on the type of the company. If I'm looking into a company that builds a mobile app, I might be looking a lot into monthly active units, so engagement metrics. If I'm looking into a company that does enterprise, I'll look a lot into what is the sales cycle like? How long did it take for them to sell into this particular customer, and how much can they grow this contract, right? So the metrics may be same for many different companies, but the weight, that's where the know-how of a venture capitalist comes in. How much weight do I give to different metrics, and how much do I compare them? What is the cohort that I compare them against other companies? All of that, there's a science to it, but there's also an art to it. At the end of the day, if I am investing in a company, it is, so at the end of the day, like I may analyze to death, but some of it will be a gut instinct. And I have a data bank in my head of having done dozens of investments over dozens of years and looked at thousands of companies, so that when I look at a new one, I mean, I wouldn't say immediately, but very quickly, hopefully, able to go down to what's the most essential questions I should be asking. Just to give you a statistic here, actually, let me post this as a question. What do you think a venture capitalist looks at? How many companies per year on average? Throw out a number. You guys are all converging. So 1,000 is actually the average. That's right. I'll look at about 1,000 companies. That's what my track record over 10 years has been. And it's very hard, obviously, to look deeply into 1,000 companies. What I do is I'll look at a deck and I'll look at multiple signals. And within 5 minutes, I will be able to figure out, okay, there's something here in this company that is interesting to me. Let's go deeper. And typically, I'll do that for about 100 companies. And by the way, I'm talking about for years, right? And in 100 companies, I'll take a meeting, and that will be maybe an hour of my time. And then I'll be able to say, okay, is it worth a second meeting? I'll narrow it down once again to maybe 50 companies. And I'll keep narrowing it down. But bottom line, in any given year, I'm maybe looking at 20 companies, so maybe one or two at any given time, where I'm putting 50 to 100 hours worth of work to understand them, their competition, their team, their technology, their use of funds, their product, et cetera, et cetera, et cetera, et cetera. And I'll create a deal memo, and I'll do reference checks, and I will debate it within my own venture capital firm to figure out, okay, is this an investment we want to make? And I will end up making maybe 2 or 3 investments a year, maybe 4 or 5 on a really good year. So think about the odds of a company being funded. Like, there's thousands of startups, but only a fraction of them will get funded by a VC, by any one VC. there's many other VCs out there that may actually end up funding many of the startups. But it is, once again, a power law game. Of the thousands of startups that get created, maybe a handful of them will actually end up succeeding big time. So think about it, thousands of companies at the seed stage, maybe hundreds of companies at the Series A stage, dozens of companies at the Series B stage, and a handful of companies at the Series C, D, and E stage. So at this point, you should be making, many of you probably know these terms, it's a funnel. Series A, seed means, let me actually start from the beginning. Seed means that you have a prototype. Series A means you have a product market fit. Series B means your business model is taking off. Series C means you're doing growth. You may be acquiring new companies, you may be just expanding, and so on and so on. Series D, E, and F, and so on. So hopefully all of that makes sense. Let me take a pause because I want to open up another topic here based on the questions that Aman made, which is, how do you become a venture capitalist? Which is a very common question I hear. So just like an entrepreneur, VCs come in all sizes, shapes, and forms. There's no requirement that you need to do X, Y, and Z in order to become a venture capitalist. I have written articles about this, by the way. If you get curious, there's a bunch on my LinkedIn and they get posted in many other places. But there's one article I wrote specifically on how to become a VC. And I outlined 4 different ways, roughly, to becoming a VC. One way is that you do an undergrad, probably in a technical field, you work for a few years, you probably go to business school, and at some point, either after business school or maybe even before, you join a VC firm and they get interested in you because they see you have the potential. You don't necessarily have the experience, but you have the potential to find good companies. So hustle, diligence those companies, meaning do your homework to understand them, where your technical background typically comes into use, and that you have good judgment. So judgment means you are able to work well with other people, work well across other venture funds, work well with other entrepreneurs, right? So I would say hustle, diligence, and judgment. Those are the 3 criteria. Can you demonstrate all of that without having done an undergrad and then a business school? Sure, you can. Some of the most successful VCs did not go to business school. I have not met a VC who has not done undergrad, but I'm sure there's 1 or 2 out there. But the typical paths to do that. A second path is you become an entrepreneur. You could become an entrepreneur at many points of your life. You could have dropped out of college. You could have spent 40 years working and then decide to become an entrepreneur. So there's entrepreneurs spanning all kinds of backgrounds. But some entrepreneurs, especially once they become successful, they either take their own money or the VCs that funded them say, hey, look, we really liked you. We think that you're a very good player. Now come become a coach. So some entrepreneurs make that leap. And my background in some ways has been like that. I did go into venture capital from business school, but then I went on to become an entrepreneur. And I would like to say the company I built is proving to be successful. So then I decided to go back into venture capital. So I'm a mixture of path 1 and path 2. Path 3 is you just decide to raise your own fund. And there are people out there who have raised funds with some experience or with no experience. I know people who have been able to raise a fund because they just are very good at sales and they go and talk to all kinds of LPs out there. LPs, by the way, is the term in the industry for the people who invest in you as a VC. VCs are basically GPs, general partners. LPs are limited partners. So in a venture capital fund, limited partners are the ones giving the money. General partners are the ones investing the money. And people think of GPs and they call them VCs, right? So it just happens that in a VC firm, there's actually a lot more behind that you don't get to see. But anyways, going back here, a third way is just raise money. And let me warn you, in case you're deciding to do that, um, if if you think raising money is hard, I assure you that raising money for a VC fund is incredibly challenging. You're basically asking people to give you money um, to invest on your behalf. You really have to convince them why you are the best person to do that. Um, Maybe you get lucky, like maybe you have a family that's wealthy, maybe you're very well connected, but otherwise you're looking at thousands and thousands of meetings over multiple years to convince people to give you money to raise your own fund. um, but anyways, going back here, these are the three ways that I outlined on how to become a VC. The fourth way, the fourth major way, is you just start helping a VC fund. Maybe you are in a company, you have put in 30 years into that company. So you have been advising a company and advising a venture capital fund. And let's say you have a lot of experience in healthcare, and the venture capital fund keeps saying, hey, help me with analysis on this company, or help me connect with other entrepreneurs in healthcare. And slowly but surely, you start helping them more and more and more. And eventually the VC fund says, you know what, we just want you to actually become an investor with us. So that's the fourth major way. These are not the only four ways, but these are the four major ways to become a VC today. And these things keep changing. So maybe there will be a fifth major way once the industry changes. Path one. So Aman is asking me what path one is. So the path one that I said is essentially go to good schools and work. And at some point, a VC fund will ask you to join them because they see potential in you. It's basically building your career as a venture capitalist. You come in fairly junior into a venture capital fund because they see potential in you. Like you go to good schools like Harvard or Stanford or UPenn or Berkeley, right? Like schools that have a good brand, good network, where people, good entrepreneurs have come from. And you typically study something that will be relevant to working with startups. And then you work for a little bit to show that, yes, you actually are a competent operator. Maybe you started a company and ran it for a couple of years, but essentially have enough proof points in you that a venture capital fund will invite you to join them. Let me warn you, in case you decide to do path one, the demand for positions is much lower than the supply of people, very capable people who are looking to join a venture capital fund. It's literally thousands of candidates looking for one or two spots. So how to get into a venture capital fund requires a huge amount of hustle, a huge amount of networking, basically proving to them that you are just the right candidate as opposed to all of the other candidates. And what I counsel anybody, if you're looking for that path, is figure out what your differentiator is. Like figure out what you do that is unique, that is better than anybody out there, that you could help that VC fund. Like let's say that VC fund is focused on investing in drones, and you have spent 20 years of your life working with drones. You built drones. When you were 10 years old, you were flying drones. When you were 20 years old, you were studying aeronautics at MIT and specializing in drones. And then you worked for a drone company. So then you go to this VC fund and say, look, I live and breathe drones. If you're looking for a drone person, I'm that person, right? So that is one way of capitalizing on path one.
What was your background like before becoming a venture capitalist?
I grew up actually in a small city, far from, like an hour by plane from Rio. Um, and my parents are Indians. They immigrated about 50 years ago. It's a little bit of an unusual background. I grew up as the only Indian I knew in Brazil. So I grew up with multiple languages, different cultures. Eventually, I moved to the capital of Brazil, which is Brasilia. I got a scholarship to one of the best high schools in the city. And that school was bilingual. So I studied in both English and Portuguese. Until then, my schooling had been in Portuguese. And got an opportunity to learn more about the US and the schools here in the US. When I was in my junior year at this school, I applied for universities here in the US. I got accepted into Stanford, and I came out here as a freshman. I did undergrad in computer science and biology. I was a pre-med engineer. Um, Always had a passion for using the combination of life sciences and technology. I did do a master's at that intersection. My research was taking proteins and building computational models to try to understand how they fold, because protein misfolding is correlated with many diseases like Alzheimer's. My collaborator actually won the Nobel Prize in 2013. And then I got into med school. I was going to go and become a doctor, but I also got into Google, which at the time was a private company, and it was something I was very passionate about. And I, for a variety of reasons, decided to go to Google, and I ended up joining in a role that is perhaps known to many of you at this point. It's called product management, and I was in a particular program that Google offered. I was the third class to go through this program, where they would select 10 people and literally put this into the fire. We were in charge of products, and we were expected to take care of them just like anybody who had far more experience. So it was trial by fire, it was challenging. And I didn't realize it wasn't normal, but I was in charge of Google Images and Google Photos, which this is 15 years ago at this point, more than 15 years ago, that had 200 million users every day. But it was just an incredible experience. And I got to learn so much. And I also learned about how much more I had to learn. And I ended up working with some of the leaders really of Google that are probably well known now. I worked for Marissa Mayer, who became eventually CEO of Yahoo. I worked for Sheryl Sandberg, who became CEO of Facebook. And anyways, after 4 years of Google, I was trying to decide what to do with my life, continue at Google, build a company, or invest more in myself. And I saw that many people I respected at Google had gone to business school, had gotten a more in-depth training of the business world, which I didn't have at that point. I knew nothing about the business world. So I applied and I got into Harvard. And I went there. It was an investment of 2 years of time and money. But I'm very grateful. I froze to death in Boston, but I'm very grateful that I got to go there. And I came back to the Bay Area because I was hired by a VC firm. And that was my first exposure into venture capital. It's a firm called Norvus Ventures. It's a big one. They have $10 billion under management. And that's where I really learned about venture capital more. Ended up investing there for a few years. And then I went on to start my own company in health. We ended up raising 120 million. And then I went back to venture capital. I joined another firm, spent a few years there, made some more investments, and now I've started my own venture capital fund as of a year ago. And this venture capital fund is called Tau Ventures, TAU. It is a seed-focused fund. $17 million is what we have raised so far. We're very happy with that amount. It's a great amount for doing first investments into a company. We focused on applied artificial intelligence in health, in cars, and in enterprise. And there's a lot more on our website if anybody's curious, called tauventures.com. And I'll share one last thing. I have my roots in India, and I wanted to do more for the world. I took a backpack when I was 19, and I went into rural India. I lived and worked there in the middle of nowhere, villages, no water, no electricity. And long story short, I decided to do something about it and crowdfunded for about 20 years to build a hospital there. It's called hospitalforhope.org. If you guys want to help, give a like on Facebook to the hospital or on LinkedIn. There's a couple of articles on it. Every like helps us raise more money with the donors.
What do the back ends of funds look like?
Depends on a fund-to-fund basis. Large funds, especially these days, have armies of people that help startups hands-on. Andreessen Horowitz is a big fund. It's over $1 billion, and they have 300 people working there whose whole job is to help the portfolio companies. I am a seed-focused fund with one partner, so two of us, with one intern, but I do have 80 advisors and 80 plus LPs, meaning my own investors, and 11 entrepreneurs, about to be 12 that I've funded. So I have big groups of people around me, but at the end of the day, my fund is me and my partner. So one of the things we believe in is to actively help the companies, but we have to be very focused on how we help the companies. So I focus on two things. I help them get more customers so that they can make more money, and I help them get more money. Those are the two things I really focus on. Everything else, I will obviously help them as much as I can, but at the end of the day, it's the CEO's job. So let's say the CEO comes to me and says, I need to hire somebody to be my chief medical officer. I'll say, look, great, let me connect you to somebody else who can actually help you do that. Or think about this, or think about that. Or another CEO will come to me and say, I'm trying to figure out what the pricing for my product should be. And I'll say, well, look, think about these things. This is a framework for you to think, and I'll give them advice, but I won't actually execute on this. I have to be very careful and mindful about how I spend my time, because otherwise I won't be able to do justice to all the other companies we have, or to my own investors, or to finding new opportunities. So with that, I just want to say thank you to you all. I'll leave you guys with one small message. We're living in particularly challenging times. Like, let's not minimize this. This pandemic is an absolute nightmare. I don't think any of us wanted to be in it. The way I'm looking at it as a venture capitalist is that a pandemic fundamentally changes the world, and we have to adapt to it, and we have to find solutions for it. So whether you're trying to solve the problems of the world right now directly or indirectly, I encourage all of us, myself included, to look at a crisis as an opportunity to do something better. So I'll leave with those 2 cents here.